Hello students, I hope all of you are doing great. So in this section, I am going to review the midterm exam 1. So especially in this section, we will be discussing what are the items that will be tested on the exam 1, and we will be discussing some of the concepts that are required to explain to all of you, and I'm sure that all of you will see all the items or concepts that will be tested in the exam. We have already discussed in our class, but even after that, I will be discussing some of the concepts. Okay, let's start. So, midterm review 1. So, let's have the pen over here. So, this pen, okay. So, now, so we will be discussing the midterm exam 1, and let's see what we will be covering in this exam. The first one, that from the chapter 1, we will be testing on the conceptual framework, and I will discuss again, even though we have discussed the conceptual framework of accounting in our chapter 1, and then from chapter 2, we will be testing the journal, ledger, and unadjusted trial balance. We already know about that, and then we will be discussing that there will be a problem on adjusting entries, and the another problem will be on the closing entries. These are all from chapter 2. And then cash flow statement classification, that is the operating, investing, or financing activities. And then this is from chapter 3, and cash flow statement in direct method, chapter 3, and classified balance sheet from chapter 4, income statement from chapter 4, and revenue recognition from chapter 5. Okay, the first one. Let's have a recap, rediscussion of the conceptual framework of accounting from chapter 1. So we know that the conceptual framework is like a constitution of accounting, and it has the rules and regulations that will be followed by the accountants when they are maintaining their books of accounts. So there will be some basic foundations. So it is actually a foundation on which the accounting stand, right? So there are different elements of this conceptual framework. The first one is objective of financial reporting, then qualitative characteristics, the elements of financial statements, recognition, and measurement and disclosure concepts. There are some assumptions, the principles, okay, and there is one constraint of accounting, that is cost effectiveness. So, and the financial statements, the balance sheet, income statement, statement of comprehensive income, statement of cash flows, and statement of shareholders equity, and finally related disclosure. So first of all, we'll be discussing about the objective of financial statements, okay, or financial reporting. So what are the objectives of financial reporting? So to know the objective of financial reporting, let's have an example from Amazon's statement of operations. So you can see that from Amazon's statement of operations, you can see the net sales of 2013, 14, 15, 16, and 17. So from all this information, you can predict. See, in 2013, the net sales of Amazon was 74,000. Then it is 88,000. Meaning these are millions. 88,000 millions, 107 million, 135 million, 177 million. And the operating income, net income on net loss sign. So the information that we have. So from this information for the years 2013, 14, 15, and 16, so we can have an idea that what will be the net sales or operating income in future years. See, the trend is increasing. So this one, it is increasing, right? So let's see. This is the information, and here is the graph. So actually the basic earnings per share. So basic earnings per share is actually increasing over the years. So it means that it will be increasing because the curve is upward sloping, right? It is going upward, so it is increasing. Over the years it is increasing. Okay, so this meaning the financial reporting will help us to predict the future performance of the company. And let's see the cash flow of Amazon. So here are the cash flow informations over the years. Net cash provided by operating activities from the statement of cash flows. So if we draw a line, we can also see there is an upward sloping curve over here. So we can also predict that the cash flow will be increasing in future years of Amazon. So the main objective of financial reporting is to help the investors to know whether the performance of the company is increasing, meaning is whether the company is doing better or not. So that you can decide whether to buy the shares or not. So objective of the financial statements, let's see. So to provide financial information about companies that is useful to companies, meaning capital provider, in making their decisions. So investors decide whether to buy, sell, or hold the equity or debt securities. So and then the companies, the creditors, meaning the financial institutions, they will decide whether to provide or settle the loans on the basis of the cash flow statement or income statement. So to provide information that is useful to capital providers, and finally to help identify strengths and weaknesses and assess the liquidity from the cash flow. So liquidity from cash flow, can you see that? And the solvency of the company. This is also from the cash flow we can see the solvency, or from the balance sheet we can see the solvency. Okay, so that are the objectives of financial reporting. And let's see the second part here. The second part is the qualitative characteristics of financial reporting. So the qualitative characteristics of financial information are, so we know that there are two different types of characteristics, the fundamental and enhancing characteristics. So fundamental, we have two: relevance and faithful representation. To be relevant, the accounting information must have the predictive value, confirmatory value, and it should be material. And to be faithfully representative, the information must be complete, and it should be neutral and free from error, right? And there are different enhancing characteristics. They are say comparability, and there is also consistency, verifiability, timeliness, understandability. See that. And cost effectiveness, it means this is a constraint of accounting information, that is your benefit must be greater than cost of maintaining accounting. Okay, and so the fundamental characteristics and the enhancing characteristics. So let's discuss in detail. So the fundamental characteristics, there are two, right? So for financial information to be useful, it must possess the fundamental decision specific qualities, and they are the relevance, and the second one is faithful representation. Okay, so to be relevant, information must have predictive value. So how what does the predictive value means? Let's discuss this one. Say in 2013, 14, 15, we know that net income information of company. So net income in 2013 is 10, it is in 15, and it is in 2015 it is 20. So it means that it is increasing, right? So from this information, from these three numbers for the 3 years, 13, 14, and 15, we can predict that the curve is upward sloping. So that is why the next year's income will also be higher than this one. So a predictive value helps users to predict a company's future cash flows, especially, or future earnings, right? And then confirmatory values, it means that you have the information. Okay, say for example, you have the income statement, and for the last 5 years. Okay, so from the last 5 years, so you have predicted for the year 1, 2, 3, 4, and 5. So from these 4 years, you have predicted the fifth year, and finally you got the fifth year's income statement, and you found that your result, actually your prediction was close to the actual. So it means that the information that will be provided by the financial reporting must have a confirmatory value, and then the financial reporting information or the information must be material to you. Okay, so if it doesn't have any materiality, so you may not care about the information. See that? Okay, and to be relevant, an information must have the capacity to make a difference in the decision process. Okay, let's see in detail. So these are the information. So to be relevant, information must make a difference. Can you see that? In the decision process. And to be relevant, information must have the predictive value, as we said, and the confirmatory value, and finally it must be material. And predictive and confirmatory value, let's have an example. So from these examples, so we can say that the meaning these are the information. So you have 13, 14, 15, 16, and 17. So we have these 5 years data in our hand, meaning the sales information, and we can see that the sales curve is going upward. Can you see that? So the next year, meaning in 2017, what will be the sales in 2017? So we can predict that. Okay, so this information have the predictive value, and it also confirms our previous prediction. And now let's discuss about the faithful representation. So to be faithfully representative, the information must be complete, meaning it will include all the informations. Okay, it must include all the necessary information, and information must be free from bias. Okay, which is actually neutrality, and it must be free from error. So nothing should be omitted from the financial reporting. So these three information, meaning these three quality must have to be faithfully representative. Okay, so we have, so you can see that the faithful representation exists when there is an agreement between a measure or description and the phenomenon it purports to represent. So they should be complete, neutral, and free from error. And let's have an example of faithful representation. So think about that this is a partial balance sheet, and this includes, this is the headline of the inventory. So inventory has raw material inventory, work in process inventory, and finished goods inventory. We can also see an item, accounts receivable. Can you see that? So does it faithfully represent that accounts receivable is an inventory? No, this is not an inventory. So that is why this accounts receivable doesn't have faithful representation. It should not be on the list of inventory. Okay, and then it is not. Okay, and now the enhancing qualitative characteristics. So to discuss the enhancing qualitative characteristics, we first define let us discuss the comparability, verifiability, timeliness, understandability. Okay, so first of all, say comparability, and there is one term, you can see that consistency. Okay, so to be comparable, the financial information, say company A and company B. Okay, to be comparable, both company A and company B must follow the same accounting rules and regulations, must follow the same accounting principle, so that we can compare. Can you see that? And to be consistent, company A, say this is within the company. Company A will be reporting for the year 1 to 3. So they will be following the same accounting methods over the years. Can you see that? So this is consistency. And verifiability, it means that when you have the information, this information must have the capacity sorry, to be checked for the accuracy, completeness, and reliability. So it should be verifiable. And timeliness, it means that you must have the information before the information loses its value. Okay. For example, suppose you have purchased, there are 3 time points. So point 1, point 2, and point 3. You have purchased, say it is January 1, and this is February 1, okay, and this is March 1. So you have purchased 100,000 shares of Apple at this point, meaning January 1, and you have received some information on February 1, and on the basis of those information, you should not buy the shares of Apple. Can you see that? So, but you have received the information after purchasing the shares. So this information is not timely to you. So meaning this information has lost its usefulness to you. So that is timeliness. So you must have the information before the information loses its usefulness. And understandability, it means that the information that an accountant is reporting or presenting to the users, it must have sufficient transparency, and it must not be written in technical terms, so that everybody can understand. So everybody will be understanding the information in the financial reporting, so that will be understandable. Can you see that? So these are the enhancing qualitative characteristics. So I will suggest you try to understand the comparability, meaning between the companies. So between the companies, the same accounting principle must be followed so that they can be compared. And consistency means within one company, you will be following the same accounting methods over the years. Okay, year 1 to 3. Okay. So elements of financial statements. So there are 10 elements of financial statements, and let's see what are the elements. So the statements of financial accounting concept number 6 defines 10 elements of financial statements, and these elements are the building blocks. Can you see that these are the building blocks? Okay, with which financial statements are constructed. The classes of items that financial statements comprises, they are, see, the 10 elements are assets, liabilities, equity, investment by owners, distribution to owners, revenues, expenses, gains, losses, and comprehensive income. These are the 10 elements. Okay, the first one is asset. Asset is the asset is something from which we will be having future economic benefits, and this asset is controlled by the enterprise. Okay, and then second one is liability. Liability represents the obligation to other entities. If you owe some money to other entity, that is, you have a liability. Then equity, it means the residual amount. Residual amount, why are you calling this one residual? We know that assets equal to liabilities plus owner's equity. Okay, so if we subtract liability from asset, we have owner's equity. That is why it is the residual, meaning the remaining part. Okay, after subtracting the liability from the assets. So residual amount, the owner's interest in assets after subtracting liability, as we saw. And then the investment by owners. Okay, so the investment by owners is another one. So investment by owners, And distribution to owners are the transactions that describe any owner contribution to the company or withdrawal from the company. So say for example, we invest capital. Okay, if we invest capital, that is contribution by owners, and when the owners take money from the company as dividend, that is a actually withdrawal from the company by the owners. Okay, and then revenue. What is the revenue? So revenues are the gross inflows. Okay, that are results from providing goods or services to the customers. Okay, when we provide service to the customers, what we get? We get money. Okay, or what we get, if we don't get money immediately, we have an increase in the assets, say for example accounts receivable. So that is why it's an inflow of asset. Okay, revenue is an inflow of asset from providing the goods and services to customers. And then gains. What is gain? Sorry, gain means when we are selling assets after using them for some time. So, and if the book value is higher than, if the book value is, okay, let me erase this one. If the book value is higher, okay, let's see what do we have. Okay, so suppose the cost of an asset is $100, and after 5 years, okay, the accumulated depreciation is 60. So the book value is 40. If we sell these assets for 50, so after subtracting book value, this 10 is our gain. Okay, so gain comes from peripheral or incidental transaction of an entity. This is not a normal transaction. Okay, so after using an asset for some time, when we are selling the assets, so what we do, we subtract the accumulated depreciation, and then from the selling price we subtract the book value. Meaning from cost we subtract the accumulated depreciation, and we find this one is the book value. Okay, and this is the selling price. If selling price is 50 and book value is 40, then 10 is our gain. So this is our gains. Okay, and let's discuss about expense. This is just the opposite of revenue. So expenses are the gross outflows, okay, of assets that is incurred in generating the revenue. So we know about expenses, and now what is loss? A loss is just the opposite of gain. Okay, so the same thing. Think about our previous example, and think about the example. Say our cost was 100, accumulated depreciation 60, book value is 40. If we sell these assets for 30, after subtracting book value, we have a negative 10. Meaning this is the loss. Can you see that? Meaning loss is also from incidental or peripheral transactions. Can you see that? When we sell some asset after using them for several years. So this is a loss. And what is comprehensive income? Comprehensive income is actually the change in the owner's equity from non-owner sources. Oh, now let's see. So what we have, we know that owner's equity is affected by many things, by revenue, okay, by expense, by dividend, right, and by any loss or gain. Okay, so all of these are comprehensive income. Okay, even there are some comprehensive income, meaning there are other comprehensive income. For example, think about foreign currency translation adjustment. This is not our normal business operation, but it happens sometimes. Okay, so comprehensive income is the change in equity of a business enterprise during a period from transactions and other events and circumstances from non-owner sources. Here is the key point, non-owner sources. Okay, meaning this is not the contribution by the owner or withdrawal by the owner. So the conceptual framework, this is the conceptual framework finally, and we'll be discussing about assumptions and principles. Okay, so let's see the underlying assumptions. So there are 4 basic assumptions underlying generally accepted accounting principles. Then they are the economic entity assumptions, the going concern assumptions, the periodicity assumption, and the monetary unit assumptions. There are 4 different assumptions. So the first one is the economic entity assumption. So let's discuss what is this. So this assumption actually assumes that the economic events can be identified specifically with an economic entity. The ownership and businesses are separate from each other. So the business is here and owners are there. So they are separate. Okay, they are not together. And going concern assumption, it means that it is anticipated that a business entity will continue to operate indefinitely. So, and this is the owners, meaning the business economic entity assumption. Here is the business and here is the owners. So they are separate from each other. Okay. And then going concern, it means that the company will be running for a long time. Suppose we have started our company here. Now we are here. So we have a dream to be like this one. See, from the smallest to we will be having a big one. So it means that the entity or the company will be running forever. We don't know when it will stop. Okay, and it will be shut down. So that is going concern assumption. Okay, and the periodicity assumption. So think this is the continuation from the going concern assumption. Think that we don't know when the company will stop. Okay, it's going, running. Okay, so now think that if we prepare, this is the starting point of the company, and if we prepare the financial statements after the shutdown of the company, what will happen? We don't know when Amazon will shut down, when the Apple will shut down, when the Microsoft will shut down, right? So if the companies are going to shut down after say 50 years or 100 years, will we prepare the accounting information, meaning the financial statements after 100 years? No, it's impossible. Then we cannot judge whether we are doing better or not. That is why the entire life of a company is segmented into small parts, small time frame. So they are quarterly, monthly, yearly. So that is the periodicity assumption, meaning the entire life of a company is artificially divided into small segment. Can you see that? That is the periodicity assumption. This allows the life of a company to be divided into artificial time periods to provide timely information. Okay. And finally, the final assumption is the monetary unit assumption. So this states that financial statements, meaning financial elements, should be measured in terms of dollars. See that? So we will be writing all the amounts in dollars. Okay, there will be one currency. So this is just an example of periodicity assumption. These are the 4 assumptions. So the economic entity assumption, going concern, periodicity, and monetary unit assumptions, and accounting principles. Okay, there are 4 important principles of accounting, and they are the historical cost principle. It suggests that any asset should be recorded at its cost. Can you see that? Meaning the purchase price or the cost of building something. Then the realization principles. It is also known as revenue recognition principles. So it means that You will have to realize revenue, or you will have to recognize revenue as soon as you transfer the ownership of the goods to the customer. So, and then the matching principle, meaning the expense must be matched with the revenue. Can you see that? So expense must follow the revenue. And number four is the full disclosure principle. It means that you will be disclosing all the information required, necessary. Okay. So let's discuss more. The historical cost principle states that asset and liability measurements should be based on the amount given or received in exchange transaction. Okay, meaning initial. And the realization principle, revenue should be recognized when the earnings process is virtually complete and collection is reasonably assured. Then matching expenses are recognized in the same reporting period as the related revenues. And full disclosure means any information that is useful to decision makers should be provided in the financial statements, subject to the cost effectiveness constraint. Okay.